Welcome to the Real Spiel with Ryan and Kurt. Thank you all for joining us today. We've got a content-packed podcast. This is our first podcast on video, hosted by ETF Guide. This is going to be the conclusion of season one for us. We're going to cover a couple different things. The hot topic of the week, if you will, would be inflation, how the Fed is going to control inflation or rein it in. We'll also talk about asset class sensitivities to inflation, the Russia-Ukraine impact on global commodity markets, and we'll touch on some of the other inputs in commodities as we transition towards kind of this clean energy transition, if you will. So, Kurt, I see you there. Nice to see you. How's it going?
Ryan, everything's good, man. Great to catch up.
Absolutely. So let's dive right into it. We just got the CPI print last Friday. Today is Tuesday, June 14th. CPI came in at 8.6%. And then, another metric that we don't hear too much about is a producer's price index, which came in at 10.8% this morning. In anticipation of the Fed's announcement on rates tomorrow, I think most are expecting 50 basis points. Some analysts expecting 75 basis points. Let's talk a little bit about the tools that the Fed has at its disposal to fight inflation, and then also what kind of tailwinds for inflation have kept the Fed on defense this year.
This is an extraordinary number that we saw last week, right, Ryan? I mean, we were all told by the Fed themselves in 2021. This is from Chair Powell himself that this is transitory, and we're going to have, whether it's mitigation of COVID effects, other things, it's all going to come back down. And essentially, I think a lot of people thought, okay, I guess I don't need to worry about it. This is a temporary disruption, but it's not, it's not fixed. It's not going to grow. It's not, intransigent. And what we find, the future is hard to predict. So just like we all thought inflation was going to go up a lot back in 2010, 2011, we had huge QE, trillions of dollars of monetary stimulus out of the financial crisis. And we thought that inflation was going to go up, and it didn't. And inflation was pretty anemic during the 2010s. That was a great backdrop for stocks and for bonds. We saw low interest rates, low credit spreads, an incredible decade of returns for equities generally. And now what we're finding is as hard as it is to predict that inflation will go up, it's equally hard to predict that inflation is going to stay down and go down. And in fact, the opposite is happening. And I think this is a huge wake-up call for the Fed, for markets, for economists, for central bankers around the world. It's a big number. And the 8.5 that we saw just a few months ago was the highest that we'd seen in 40 years. This 8.6 print as of last week for May is even higher yet. And you mentioned, Ryan, what are the tailwinds, right? And as I said, the future is hard to predict. So things like a land war in Europe fought with machine guns and artillery. I don't think anyone had that in their forecast for 22. I mean, I think that even as Russia was massing troops on the Ukrainian border, there was a huge amount of skepticism they would actually roll in. And in fact, it appears that the Russian troops themselves, many of them did not realize this wasn't a training exercise. They were actually going to roll into Ukraine. The other thing that's very hard to predict is how does this get resolved? And I don't know, Ryan, but if you speak for yourself, I thought this was going to end pretty quickly, right? I mean, it's the Russian army.
3-4 months in, and they've really, I would say, disappointed and overestimated their capabilities.
Absolutely. I mean, we're more than 100 days, and Russia has not been able to take Kyiv. They've not been able to take parts of northern Ukraine. They've now focused their limited resources and troops in eastern Ukraine, which was already sort of Russian leaning, and where they took land and resources back maybe in 2014, 15. So all these things are very hard to predict.
I don't want to interrupt you here, and I know there's a lot that we can talk about with Russia and Ukraine, but just in terms of, again, where the Fed is now in anticipation of this announcement tomorrow.
Sure.
What are the tools that they have at their disposal to fight inflation.
Sure. So I guess we were just recapping how hard some things like critical economically important things like inflation are hard to forecast. They're hard to predict. Well, one of the things the Fed does is they try to support employment. We saw that after the financial crisis. They dropped rates to basically zero for almost a whole decade, combined with other central banks around the world, with some of the legislatures, U.S. Congress, Europeans, legislature elsewhere. We had fiscal stimulus, which helped to create employment. Employment is very tight now. Employment is sort of at record lows. Unemployment is at record lows. So full employment seems to be pretty intact. That's one of two jobs the Fed has. The other job they have is to control inflation, and that seems to be sort of out of control right now. They don't have a tight grip on it. It's expanding faster and more furiously than they anticipated, than the market anticipated. The Fed has just those two simple goals, support full employment of the U.S. labor force and help to control price increases and inflation. Their tools are very limited. They really, interest rate policy is probably the most effective and direct instrument that they can control. We all know that the Fed has just begun to hike off of the zero interest rate base. So we have interest rates of around 75 basis points right now. It's been announced by the Fed that they plan to hike over the June, July, and fall meeting. If what the Fed has revealed before comes to fruition, we're looking at somewhere between 2 to 2.5% interest rates by the end of the year. I know some of the market noise and the chatter, Ryan, has been about, well, maybe they're going to hike 75 basis points. Maybe because of this huge print, they have to do something more, I guess not severe, but just more intense than what they had messaged earlier, just last month. The problem is we have 8.6% inflation right now. So if the Fed even accelerates, let's say that we hike a little bit more than we thought, and we get interest rates to 3% at the end of 22. As of right now, you're still going to be 5 percentage points, 500 basis points behind actual inflation. And we just don't know where it's going to go. I think one thing that's interesting to talk about is, what are the things that could support inflation going forward and could continue this kind of drama that we're seeing.
Right. And so you mentioned, transitory is something that I don't think anyone's using anymore in terms of inflation, and entrenched is seemingly where we are. Maybe we should talk a little bit about asset class sensitivities to inflation. Commodities have ripped this year. Most commodity indices are up over 40% year to date. Equities are down 20+%. When I joined USCF, almost 7 years ago, and we began working with one another, a lot of folks were, kind of tepid on inflation expectations, but knew we were somewhat behind the eight ball there. It had been a tremendous decade for equities and a really tough time for commodities. But that's just the 2010s, and we all suffer from recency bias. And looking, just one decade prior, the 2000s, really equities, for the duration, there was some obviously volatility, but largely nothing for that 10-year period from start to finish, while commodities did extremely well. So maybe this would be a good time for us to talk about maybe SummerHaven's 150 years of investable commodities research and some of the compelling research that you guys have put out on your website and presented many times on various webinars and at different trade shows and events. Can you talk a little bit about that research and what went into it and kind of the key findings for SummerHaven's 150 years of commodities research?
Sure, Ryan. I mean, you can see on the kind of wall behind me that we've got these artifacts about commodities and commodity markets that go back hundreds of years. I think investors really didn't start thinking, or analysts didn't start thinking about commodities as an asset class broadly until maybe a couple decades ago. But commodities are not new. They've been part of human civilization for thousands of years. In fact, the first futures exchange, which was based around rice contracts in Japan, started almost 500 years ago. So these aren't new markets, and they've been tracked in periodicals and newspapers, exchange handbooks for, over 150 years. So SummerHaven went and collected all of that data. And it took us about 5 years, but we went all the way back to 1871 when what we call the MERC, the Chicago Mercantile Exchange, started. And it's a rich source of financial history that is really important to informing how things performed in the past, and can give you a lens about how to think about where we are today and the future. One of the things that came out of that is that there's more than a couple hundred commodities that have traded on exchange, on futures, over the last 150 years. And in the study that we put out and publicized, is available on our website and other sources, we looked at a very simple, equally weighted index of commodity futures, and compared that to stocks and compared it to bonds. And what we found that was surprising is that the return capture of commodities over this period from 1871 to 2018, when the study ended, roughly 150 years, the long run return for commodities was comparable to equities. That itself is sort of sensational. And the volatility was comparable. So when you look at it on a risk-adjusted return basis, so something that we call a Sharpe ratio, where you look at returns compared to volatility, ironically, they both come in about 0.4 over their 150-year history, whether you're looking at essentially the S&P 500, or you're looking at just a very simple commodity beta based on diversified commodity futures return. I think that is quite contrary to most people's understanding of commodities, that they are that old and that they over time generate this risk premium, this return. The other thing, Ryan, I think that came out of it that was really interesting is that inflation is just a big separator of when those returns differ. So commodities and equities in history tend to make money at different times.
Very low correlation.
So they have close to zero correlation. If you look at them as lines over the course of 150 years, they dance around each other. So over those decades, when do stocks outperform? Historically, it tends to be when interest rates are low, when inflation is low, when financial conditions are supportive for equities. Commodities do well when inflation tends to rise, when you have unexpected inflation shocks, like the 1970s. And so I think that what we're seeing right now in 22 is this economic factor of inflation affecting these asset class returns. And at least thus far, roughly halfway through 22, it's been very tough for both stocks and for bonds, while commodities have generally performed to new highs that we haven't seen for a decade or more. I think that inflation as a key factor in asset class returns is really important for people to keep in mind, because as I said before, we don't know that inflation is transitory. We don't know that COVID's going to go away. The Fed's going to contain inflation. Everything's going to come back to normal. We just don't know. It's unpredictable. And I think diversification is one of those few free lunches that people can use when they're forming a mix of asset classes. And I think things like real assets, that's why we do this Real Spiel broadcast, I think are often overlooked and underappreciated.
Absolutely. And aside from these, inflation shocks that we talked about, commodities tend to do well in geopolitical, hardships or geopolitical problems like we've seen in Ukraine and Russia. So let's get back on track there. Energy makes all the headlines, and it's an extremely important commodity sector. But what a lot of people don't realize is how many other commodities come out of that region. I mean, 20 to 30% of the global wheat production comes out of Ukraine and Russia. Nickel. What are some of the other commodity markets that have been rocked by this Ukraine-Russia?
I think it's almost impossible to overestimate the impact that wheat's going to have on the global food markets and supply. As you said, a huge portion, in the neighborhood of 25-ish% of the world's exports of wheat come from this region. But for some regions in the Middle East and Africa, we're talking about 80 to 100% of their national supply of wheat comes as an import from this region, and they're not going to be available this year. That's a huge deal. I mean, just go back to the Arab Spring. That happened really kind of out of North Africa along the Mediterranean coast, and a lot of it had to do with inflation related to wheat and insufficient wheat supplies, and just national prices increasing to create famine or hardship for their local populace. So I think that's going to be absolutely something to watch. But it's not just wheat, right? It's corn, it's rye, it's barley. There's something called an oil seed, sunflower oil. We might see that in the grocery store in the U.S., but compared to soybean oil, vegetable oil, or other things, maybe it's not as important in the U.S. In Europe, it's critically important. If you go and get fish and chips in the UK, it's almost certainly fried in sunflower oil. And those exports and that supply is incredibly tight. Prices have gone way up. A number of importers have not been able to meet demand. And then beyond these kind of grains, oil seeds, we've got the metals that you mentioned. I mean, nickel is an important export from Russia. Aluminum, copper. We also, substantial amounts of gold come out of this region. So if you were going to pick a geopolitical region of the world that could disrupt commodity markets, it's hard to pick one as intense to global supply and demand as the Russian, Ukraine region, as the breadbasket of Europe and partially the world, but also in terms of these other critical, commodities. And Ryan, we didn't even touch on things like oil and gas, which, Russia is a huge producer of these. They create a huge amount of their access to foreign currency. And you see that playing out. You see, natural gas prices in Europe very high. We're seeing gas prices at the pump in the U.S. now averaging over $5 a gallon for the first time in decades. So, we're still in the weeds in that.
Yeah, absolutely. And before we wrap it up, Kurt, I just want to again kind of change gears here a little bit and talk about, albeit the slow transition, but it will be unavoidable as we move towards this clean energy transition towards electric vehicles and renewables. It's coming. There's no doubt about it. And you talk about gas over $5 a gallon, and kind of this push from the administration to go clean. It's going to take some time, but it is coming. Aside from maybe copper is one that stands out to us. That's a critical input for a lot of the storage and transportation of electricity. What are some of the other commodities you think that will be kind of critical towards this transition moving forward?
Yeah, I mean, I think that's a great point, Ryan. I mean, this is something that's unavoidable. I mean, it's just happening, whether it's in Europe, Asia, or the U.S. in the Americas. This shift towards a combination of renewable energy generation, so wind, solar, maybe geothermal, other sources of renewable energy, that combined with the electrification of transportation, so electric trains, electric buses, electric cars, it's happening real time. It does not change in 3 months or in 6 months, but you look at this exponential growth of vehicles on the road that are purely electrically powered, so not even hybrid vehicles. And I think we can all see that this shift, this direction is happening with or without government support. The consumers themselves are taking this direction. So what does that mean? What's going to happen? So I think a couple of things that I would highlight. One is we need to improve our electrical grid in the United States. It's antiquated. That requires large amounts of aluminum, large amounts of copper. There's nothing that can transmit electricity really as cheaply and efficiently as copper. The only other two metals that can hold a candle to copper are gold and silver. And I think maybe except for Elon Musk's personal Tesla, I don't think we're going to see an electric vehicle wired with gold wiring anytime soon. Copper is just necessary. You just have to use it. Copper is in relatively tight supply versus demand. And I think that we've talked about supply shocks, things like oil or wheat coming out of Russia, Ukraine, that we expected to be in global transshipments and available to the broad market, and they're not. It's not just decreased supply that can affect prices. It can also be increased demand. Sometimes they can both happen at the same time. So we're seeing a demand shock, I think, in with respect to copper, with respect to nickel and some of the metals that are used in electric vehicles and in battery technology. I think aluminum is a very plentiful resource, but still requires an energy-intensive process to refine and purify aluminum. And we're seeing things like Ford pickup trucks being made from aluminum chassis and bodies. Aluminum is lightweight. It lends itself towards something that, whether it's an aircraft or a vehicle, that could be fuel efficient. I don't know that the world is ready to meet this new demand for copper and other critical industrial metals as we inevitably transform our energy generation and our mode of transportation towards this green energy. So I think that's a long-term interesting space to watch. On the supply side for things like copper, it's also geographically constrained. You see most of the copper, say 40+% of the world's copper ore, comes from Peru and Chile. Chile has a new national leader, Boric, who came into power last year. He's fairly liberal. He's pro-labor. He's pro-environment. He's blocked a new mine from expanding based on environmental concerns and potential hazards to water supply from their kind of mountaintop, glacial storage of frozen water. So all of those things say we could be seeing at the same time slightly tighter supply while we're seeing what could be a sustained growth in demand. And I think that's a very interesting setup for metals generally.
I think that'll do it for us, Kurt. This is the 12th episode that we've put out for the Real Spiel. This will be the end of our season one. We'll be back at the end of summer with some new content and research to share with you all. Definitely appreciate ETF Guide for having us. Thank you all for joining. You can subscribe at your favorite podcast platform or service. You can also find our other podcasts on USCFinvestments.com. And we'd love to hear from you as well. You can shoot us an email at therealspiel@USCFinvestments.com. And we look forward to reconnecting with you at the end of summer.